Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. All right. Good morning. Welcome to the BOGART Effect. I've got Nate with me today. So first time you and I doing a podcast together. I'm super excited.
That's right. Yep.
We're going to talk a little bit about how to get started saving. And, Nate, I appreciate you coming on. This to me is evergreen content. It's things that we really should be talking about more and more and more and more. When I look at our population, we've got 336 million Americans, and a staggeringly low number of Americans that have less than $1 million of investable assets, and even lower percentage that have less than 5 million of investable assets. It's amazing to me to hear the data points. Again, 336 million Americans, only 4.8 million have $1 million saved, investable assets, and 1.8 million have 5 million saved, right? So, this is a conversation where I can't emphasize enough, and I know you and I are going to talk about it today, but how to get started as soon as possible, right?
Yes,
and save early, save as much. We have the terrible jokes that we use in some of our presentations. The financial advisor and us, we're going to have you save every dollar you make, leave nothing left to live. Like, the plan's going to work great. We'll have you work to your 80, you die at 81. Plan's going to work great, right? But I think financial literacy is a big part of this conversation. And I think, really that's what I want to emphasize today as we get in. So before I steal all the hot air, Nate, thanks for joining.
Hey, thanks for having me.
So talk to me a little bit about why it's so important to start saving early.
Well, like you said, I think that's the biggest thing to touch on here. Why start saving early? It's because it builds. These are skills that you learn when you're younger. It's foundation that you grow on. But the earlier you start saving and investing, the better you'd be later on in life. So I think that's the main point here. But above that, I mean, everyone from someone in their early 20s to someone working in their 30s and 40s, high earning years towards your 50s, and then into retirement, everybody has their goals. So if you think of your financial goals, how do you get there? You get there by saving, and you get there by investing. So,
well, and the main reason I would say, by the way, I would tell you the number one amplifier to success in investing is time. Just give it more time, right? And the longer you look at something, the probability of winning dramatically goes up, right? So one of the things we talk about a lot of times is the only guarantee we're going to have is that there's periods of time in the markets you're going to lose money. Guaranteed. Yep. Like, that is all but certain.
The longer you're in the markets, the better off you'll be.
Bingo. Yeah. Right. So, if we're evaluating risk over a 3 or 6 or even 12-month period of time, the risk is higher. Mm-hmm. But if we start looking at a 5-year, 10-year number, that risk starts to go down.
And you ended at 10 years, but the important one is 30 years, 40 years, because now we're talking retirement.
Yep. Well, and so when we talk about the power of saving, right, it comes down to compounding. Right. So $1 today is worth more than $1 tomorrow. Right. So you think about it. If I'm able to save $1 now and it goes up by 10%, now it's worth $1.10 at the end of the year. Right. And then it goes up another 10%. Right. Now it's worth $1.21. Right. Mm-hmm. So that compounded growth dramatically amplifies success. I do an exercise a lot of times when we're interacting with clients for their children. Just the decision to start doing Roth contributions when they graduate from college at the age of 21. So a Roth contribution is, $7,000 a year, right?
That's right. Yep.
And then, or $7,500, I can't remember exactly. But point is just doing $7,000 a year. Fast forward, if you just waited 10 years and started saving at the age of 31, the difference by the time you attain age 60 is almost $700,000. Mm-hmm. So that's $70,000 of contribution. So $7,000 for the 10 years, but waiting to do it by 10 years means $700,000 of difference at the age of 60.
And we'll touch on this, I'm sure, later, but like you said, these are Roth contributions. These aren't even normal contributions. So it's not only it's not only how much you can save and how long you are invested. There's also things we need to think about, like account types, taxability. Again, our goals. Your Roth account. This is a retirement account, so that's what it's used for.
Bingo. And the challenge always is, it's hard to save, especially early on when you're in the accumulation mode. I think about when I was in my 20s, especially, like, you're saving for a house, you're saving for retirement, you're saving for, a car, and then, oh, by the way, you're wanting to live, and you've got all the social pressures and everything else, right? And that's not easy. But this is where I love, especially early on, we go through goal setting exercises like you've mentioned a couple times, and we talk about how to prioritize those goals as we're trying to build out where we're trying to save associatedly. And then, life happens, right? So all of a sudden you want to get married, you need to start saving for a ring, then you have kids, now you need to save for college, right? Like, and oh, by the way, in the background, we're needing to save for retirement, et cetera. So one of the things that I just absolutely love doing is trying to teach the next generation. So, like, at this point, I'm working with my children, which are all very young, but like, how to instill some of that behavior in them, right? And then ultimately show them the success that's associated with what saving early means, right? And so, like, this is an example where if you're able to get your child to save a couple dollars from money that they've earned and then get it invested in something, I don't even necessarily care what it's invested in, just get it invested in something and watch over time how that performs. It starts to become addicting, right? Like,
it does.
I get to a point where I don't want to touch my savings because I want it to continue to keep working.
Yeah, you want to watch it grow. Yeah.
And then it turns into this like motivator of like, no, I need to save more, right, to be able to have it working for me. And that's a life lesson, I think, as early as possible we need to get into, right?
Yes. And I think that leads us right into this topic of financial planning through life stages, right? Goals and ages. You mentioned being young, a young professional. These are at this stage in life, you are trying to start investing. You're trying to put away money, like what you said, the value of time, the value of compounding. You want to establish a budget to show that you're doing the right things. You're putting money in the right places. But I think the big focus at this stage is, paying down that high interest debt that you may have. Right. This often gets forgotten, but if you can do that before offsetting your gains, you're going to thank yourself later.
Without a doubt. Yeah. And so again, I think coming back to the comment you made earlier, let's stay grounded with goal setting and planning, right? Do an inventory of where everything is and understanding where the assets are, where the debt is, what the interest rates are associated with said debt. Like, for example, young professionals, unfortunately, most of them now are coming out of college with student loans. Right?
Yes, they are.
And what are the interest rates associated with them? And then, the inevitably, I'll admit there was a period of time I had some credit card debt, right? Like, even the financial planner in me, but you're younger, it's expensive and stuff happens, right? Especially once you get into home ownership, right?
Yeah.
And you haven't had the time yet to build up the emergency fund to be able to have those reserves, right? So this is, for me, early on, it's get all the free money you possibly can. And so what I mean by that is the first place to be saving is going to probably be in your employer retirement plans.
Yeah.
Because contributing into an employer retirement plan, you're most likely going to get a match. Like Bogart Wealth, we have a match that's immediately vested. So that's, in my opinion, free money.
It's free
as
money.
long as you do it, you get it, right? That's a 100% bonus on 6% of your income, right? So if you do it, you get it. And that's where look for all the free money first, which is typically part of compensation for employer plans. But then we need to start coming through that inventory exercise and having a conversation of, do we have debt that needs to be paid down? As soon as the debt's paid down, then we can then transition over to how to save and then where to save, right? And I used my joke already, but I'll emphasize it again. The financial planner and us will have to save every dollar you make, leave nothing left to live. But there's so much truth to that, because the more you save, the more you have. The challenge, of course, is you need to live, right? We all know that. And so, what I love doing, you mentioned setting a budget. It's exactly that. And so having an understanding of what your expenses are, I'm mentoring a 20-something-year-old individual, and he and I on a let's just say annual cadence, we go through his budget, we go through his expenses, we go through where he's saving, how he's saving, and then if he gets a bonus, like how he wants to allocate that. I got to give him credit. Here he is. I think he's 27 now. He's got over $500,000 saved. I mean, just started doing that when he was 21.
Do you let him save the bonus? Do you make him save the bonus, or do you let him spend it?
I do. Yeah, I do.
Yeah.
And part of it is we have the question is where we save it. Do we save it in his, chop up his emergency fund, or do we put it into his investment account?
Well, it's also this is money you weren't expecting in your cash flow.
That's exactly right. And you shouldn't expect bonuses.
Yeah.
It should not be part of your annual expenses. And part of the conversations he and I have had is coming back to these goals, right? As we're building out the goals, especially when you're early on, I think it's important to have an emergency fund because inevitably things are going to happen. But I also think that realistically, and he's one where he's been very diligent. So part of his expenses is he has $500 every 2 weeks he puts into an investment account.
Yep.
That is an expense for him. And I call it saving for yourself first. Right. But he cognitively is wired. Not only is he maxing out his 401k, but then he's putting another $500 every paycheck into his brokerage account.
And he's probably at the point where he enjoys doing that. Right. These are healthy habits. Like what you said, these are habits
I actually just talked to him
build.
on Sunday, and I could feel the energy, the addiction that we talk about here, right? Like you see it working, but then simultaneously, like we've had conversations around like when market volatility presents itself. Do we change our mix? And I'll admit when Liberation Day happened this last year, I told him, I was like, look, you don't need as much an emergency fund. Let's get it in the markets. And, he definitely got uncomfortable. Right. But then, we were able to replenish the emergency fund back up as he had all that money now working for him.
Yeah.
So this is the power of being able to build out those savings vehicles, but it all starts with having that budget. And then why I think he has been so successful is because he's been able to tamper his budget as his life has grown. He's not going out every single pay raise or every single bonus check and all of a sudden elevating his standard of living, right? Like he's not going out and buying a new car or going on another trip, right? So it's like understanding what are your annual expenses are, keeping that aligned with where your compensation is, with prioritizing saving as early as you possibly can. The other thing I wanted to pull on with him is as he's doing that, he's dollar cost averaging. And so what dollar cost averaging is it's a saving strategy where on some consistent cadence, in his case, it's every 2 weeks, every 2 paychecks, right? He's putting money into the markets. Also with his employer contributions, a 401k and employer contributions to the 401k, that's also dollar cost averaging, right? You're consistently adding. And then coming back to our point earlier on, the longer you give this, the higher the probability of success. It works.
Especially with dollar cost averaging, right? Putting in the same amount. I mean, and the amount can vary. It could grow over time. It likely will. But finding different openings in the market, that gives you, the availability to take, say, market volatility. If the market falls, you get in. If the market's high, you get in. You don't change based on market conditions.
Which I think to the conversation you and I had earlier, and obviously we're going to be talking about other life frames, right? We were just talking about like right out of school, but when we think about like retirement savings, you mentioned it earlier. If you're 20 and you're coming into the workforce and you're not going to retire until you're 60, that's a 40-year time horizon.
But you shouldn't look at that like it's 40 years away, right? You need to look at that like this is an opportunity.
Oh, that's my point. I want the market to stay down for 39 years and then, 1,000x in year 39, right? Because I want all that contribution to be as low as possible. But I mean, that's again, not realistic. I'm the optimist. I believe over full market cycles, the markets will go up. Inevitably, you're going to have periods of time where things get hit and that's painful.
Mhm.
But the fact is that as long as you're continuing to stay invested and continuing to add, regardless of market environments, you're going to amplify the probability of success.
That is
and
right.
That's the whole
Yep.
point that we're
And
saying here.
this is probably a good spot to say, if you're watching this and you're asking yourself, that's great and all, they're talking about someone in their early 20s getting in and why it's important. It's not just important for this 20-something-year-old that's starting work and now has money and can get into the markets. This is also important for someone who's mid-career, say 30s and 40s. It's still not too late. It's still very, very important to get in now, if you want to speak more on that.
Well, candidly, I think to your point, if this is something that you've been derelict about, like if the necessity around it is even more important the longer you wait, right?
Yeah.
Like and so it's one of those things where if you didn't save for the first 15 or 20 years and you have ambitions of being able to retire and have money and not have to work in retirement, then we need to save even more to catch up for what we didn't do. And the challenge with these conversations is at a macro level, the world has changed, right? Like the era of the pension is going away, and the need to save is becoming even more and more significant.
And on the employee.
On the employee, that's
Absolutely,
right. Because
yeah.
the employer-related benefits aren't the same as what they used to be, right? And that's, when I think about it, there's only 13 true pension programs left. In 1999, 48% of companies in the S&P 500 had a pension plan. Now there's only 13 of them, right? Like, yeah, there's some legacy and components of it, but great segue though, because it's not just saving. It's how to save, where to save, right? So like, for example, I mentioned for someone coming out of school, get it into retirement plans first, simply because not only is it free money, but it's growing tax deferred or tax free if you go Roth for whatever that time horizon is, 30, 40 years, right?
And what I've found is that a lot of people have a hard time understanding this. When they think investing, they think one universal account. They might just think 401k. But I think what's really, really important for someone getting started in investing is to really understand the taxability of accounts, to understand account types, what they're used for. Say your 401k, you are not being taxed on your way in. It's coming from your paycheck straight into the 401k. But on the way out, you're paying your income tax like you normally would on that paycheck. In your Roth, same goes. You're, I guess, the other way around. You're paying the tax on the front end, and then on the back end, it's tax free. Now, these are both retirement accounts. That's why there's such a big tax advantage for using these accounts. But then you have things like your weddings. You have things like buying your first home. Any goal you have before you turn 59 and a half, you'd likely need a taxable account.
Well, and the challenge there, though, is with taxable accounts, they're great because you have flexibility and access to them, but you do pay taxes on interest. That's ordinary income. You have dividends, you have capital gains if you have appreciation. So they're not always the most tax efficient vehicle. And this is why, I think both of us are talking about the necessity of having a plan, because it does come back to, yes, you need to save early, save often, save a lot. But the reality of it is it also comes back to how are we saving and where are we saving? Because understanding we don't want to necessarily have everything in a Roth, for example, because we can't get to that to age 59 and a half. Right? Like that's not the most tax efficient way of saving. Are we pushing
back the purchase of our first home until 59 and a half? No, we're not.
Bingo. Right? Like, so it's understanding the sequencing associated with it. And, frankly, I think it's important to talk about what is the risk that we're taking with each of those respective buckets. And I personally think of risk in the context of, I frame it with time. What is the amount of time until I'm going to need these assets? So I know we've belabored the conversation around retirement, but if I'm in my 20s or 30s or even my 40s, and I've got a 10 plus year time horizon, the retirement assets, in my opinion, should be invested in a more risk-oriented manner, especially if you're continuing to be in accumulation phase and you're continuing to add to them. That should be where you're taking on arguably the most risk. But if you're saving, for example, for a wedding or a house or a car, if you have a definitive timeline, that's when we need to start pulling the risk in. right? And oh, by the way, emergency funds, in my opinion, should not be invested in the market. Because if you are in a position where you need that money, you don't want market risk to be impacting your ability to, at a minimum, emotionally pull on that money, right? You want to be able to access that.
Yeah. And let me paint this picture. You are someone who is getting ready to buy a home, and this is, early 2025. And by April, the market falls. Now, the market did recover, but if you're closing in May, you wouldn't want to be invested in that, and at the very least in such risky assets. So it's important to keep these things in mind and invest accordingly.
Candidly, I think wouldn't is nothing short of you shouldn't be invested in the market if you're closing, and that's the point I'm making around time horizon as well, right? Is if we have definitive line of sight of when we need that money, we should not be taking presumably that same level of risk.
And you should know where to put your money. Your money again if you're closing in May.
100%. Yeah. And so that's where I think alignment of time horizon with the risk, how it's invested, types of accounts is absolutely at the epicenter of this conversation. So, when we talk about nearing retirement and then into retirement, it's the same conversation, right? So as you get closer and closer to retirement, this is when we need to start throttling back the risk, right? You shouldn't have overly concentrated positions, and you shouldn't be just in equities, for example, right? We need to start tampering it back a little bit. As someone moves from accumulation phase of life to what I describe as deaccumulation phase, it's really, really, really important to make sure that we're aligning the investment strategies with the saving strategies, right? And then continue to sequence in. Now, Nate, I know, some of these things we've already covered, but why don't you get into some of the questions that we were going to ask?
Yeah. In preparing for the show, I was just thinking to myself, what are some pretty basic questions, some places to start that someone curious on how to get invested and a beginner in investing would maybe ask you or myself. So the first one I have here is how much money do I need to start?
Anything you can afford to invest.
That's right. Yeah.
And I'm obviously biased on this, but I will tell you, I save first before I spend. Right. And so I think that mindset is really, really, really important as early as you possibly can be.
Yes. Yep. And as early as you can and as much as you can.
Correct.
Yeah. The next question, what happens if the market crashes?
Don't look. The thing is I come back to that time horizon that we were talking about. You give it time, the probability of success dramatically amplifies. The thing is losing money on paper. I'm going to emphasize on paper because what you invested in will go down in value at some point in time, just like it will probably go up in value at some point in time. The thing is anytime you have an emotional response, which that's exactly when you look at losing money, it's an emotional response. Emotions and finance do not belong in the same room ever, right? It's important to segment and separate as quickly as possible, simply because if we make an emotional decision in a volatile market environment, we're going to regret it. I mean, it's all but certain. Now, I'm not saying we don't take advantage of opportunities, right? Market goes down. If I have cash, I mentioned the example of the individual I'm mentoring, we added to it. He didn't like it. I could tell you that. He was very nervous with doing that. But we added to the positions, and frankly, and I'll be the first to admit, no one knew how fast we were going to recover coming off of Liberation Day. But the reality of it is I had conviction that we would recover. It could have. I'm almost positive I said 12 to 18 months. The reality is it recovered in less than 3. So it just goes to show. Just market goes down, use it as an opportunity.
Yeah, and here is also somewhere to bring back up dollar cost averaging, right? If you aren't following the market and you're just being diligent on putting the same amount every month or every whatever the time period may be into the market, it's something you just don't think about,
Without a doubt.
Yeah.
Yeah, and that's when I come back to the comment I just made, don't look. Right?
Now you just said given market volatility, you did time the market there, or at least this your mentee timed the market. But the question I have here is, do I need to time the market?
No, but that's again what I would say. Timing the market is all but impossible to do.
Mm-hmm. Yep.
If you are fortunate enough to have a position in cash that's available that you don't need, this comes back to the time horizon thing. If you don't need that money and the market presents an opportunity, there's no reason to not. Now, by the way, I was very clear with him. There's a probability this will still go down.
Yes.
Right? Like it will get worse before it gets better. But if we're looking at this 12 to 18 months from now, we're going to be happy.
Mm-hmm.
Right. And that was exactly the conversation we had. And I'll admit, I had some cash. I got it invested as quickly as I possibly could in April. And it worked out. Right. And so, that's where I don't believe in timing the market at all. It's a fool's game if you're trying to get out at the highs and get back in at the lows. Most market timers don't have long-term success. Yeah, they'll have some short-term wins, but fundamentally staying invested and making sure the risk is aligned with your time horizon.
Yep.
Then that's the probability. That's the amplifier to the probability of success.
Mm-hmm. Yeah. And what if I make a mistake?
What are we defining as a mistake?
Well, a mistake can be anything. If, like what you said, it could be timing the market wrong, doing the things that we're saying not to do, anything like that. So
to me, I would define a mistake as you have an investment that goes down and it stays down, right? But that's not a mistake. You make educated decisions at the point in time.
Yep.
You then look for, the proverbial lemonade that we can make out of the lemons, right? And this is where, again, I'm not trying to time the markets, but I love just going more broad-based index investing simply because I diversify away individual stock risk.
Yeah.
Like personally, I'm not loading up on highly speculative technology stocks in this environment. They're dramatically overvalued.
Funny enough, I think diversification might be one of, if not the most important word of this conversation. And this is the first time we've touched on it. But yeah, like you said, diversification is really important.
When you talk about how to save, buy index funds, right? Like just keep adding to them, right?
Yeah.
And long-term, especially in the accumulation mode, when we get into deaccumulation and now we need income and cash flow, it's a totally different conversation. And the vehicles we're using need to be very different. Mm-hmm. But the reality of it is it still directly integrates back into that financial plan.
Yeah. All right. Well, before we get out of here, I do have some key takeaways, just things that I kind of wanted to wrap up this conversation with. First being, it's never too late to get started. We keep coming back to this, but this conversation isn't just for those in their early 20s or even early 30s. This is for anyone who has the dream of retiring, has financial goals. It is never ever too late.
Yep. And I would emphasize that. Set the account up. Start saving, start getting it invested, diversify, and just keep on going. If you need help, this is exactly how Bogart Wealth was built. This is what we do. And we're delighted to be a resource along the way. But Nate, thank you so much for the time today. This was fantastic.
Thank you for having me, James. All right.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.